bullseye. FMOC. Welcome back to Frank Abdo's YouTube channel, where winning with your investments is what this channel is all about. Today, I'd like to talk a little bit about interest rates and how they impact the economy. The FMOC is the Federal Monetary Open Committee that is run by Jerome Powell. Jerome Powell is responsible for setting interest rates at the federal level. Those are the best rates anywhere in the world. Why? Because the United States is the strongest country in the world, and we get to say how much we will lend money for or how much we're willing to pay if we lend it to you. The committee, when it sets its rates, it sets them for the banking system that borrows money from the Fed, and in return, the banks take that money and lend it out to the consumer in the form of bank loans, credit card loans, house loans, you name it. That's how it happens. Now, the banks also have deposits, obviously, and those deposits are paid an interest rate based on the federal rates that are set by the FMOC. Now, just to give you an idea, interest rates are generally, and it's been a rule pretty much that's held in place since its beginning in the 1800s, when Alexander Hamilton actually started this whole deal with the Treasury. The longer that you borrow the money for, the higher the interest rate. The shorter you borrow the money, the less the interest rate is. The same holds true if you invest in interest-bearing assets. The shorter period pays you less, and the longer period pays you more. Why is that? The reason for it is because the risk becomes less known the further out you go. If you borrow money for a week, you know, pretty much in a week that interest rates are going to be pretty stable, and there's not going to be, for the most part, anything cataclysmic that's going to happen in that 1 week period. If it's a month, that's a longer period. Things can change more in a month. How about 6 months? How about a year? So let's just talk about a year. When the Treasury lends money, it lends it to the banks at an interest rate. When it borrows money at an interest rate, and they get that money from investors, and investors demand a return. The investor will demand less of a return in the short run, like I just said, than he will in the long run. That's why, for example, when you look at a 1 year interest rate from the Treasury, it's paying 1.5%. If we go out 5 years, 7 years is paying 1.57. We go out 30 years is paying 2.14. So the longer you go, the more return you're going to get. How does that impact the economy, and how does it impact your investments? If interest rates are low like they are today, which are historically low, interest rates are at all-time low levels as far as the eye can see going backwards. It encourages people to spend money on housing, cars, credit cards. When they spend money on those things, then the economy hums right along. If, on the other hand, interest rates tick up, they will slow their purchases down. That's why you saw housing deposits at a very high level this week, when they reported that housing sales were skyrocketing because interest rates are low. There's another side to this, and I'd like to explain that in the next video, but that's a high-level view of what interest rates mean to the stock market and to the consumer. Thanks for listening. Subscribe and click on the bell so you don't miss the next episode of Frank Abdo Winning with Your Investment.